What's going on, guys? MMuniz here. Welcome back to the channel. In today's video, we're going to talk about the famous ETF that everybody loves, or they love to hate, Qyld, or as we call it, Qyld. More specifically, this video is going to talk about investing in Qyld on margin in the summer of 2022, as well as moving forward. Now, for those of you that don't understand what margin is, that's okay, because I will give a brief explanation of it in this video. After that, we're going to take an in-depth look at multiple scenarios using Excel spreadsheets of increase in margin rates, decreasing Qyld price per share, taxes, and even what I think will be an actual outcome moving forward. But before we get into any of that, we got to give a disclaimer, especially for this video. So 100%, this video is not financial advice. I'm not a financial advisor. This video is just my opinion, and all I'm trying to do is share my opinion and kind of make you guys think a little bit. It's 100% theory, and all it's meant to do is spark some interesting conversation down in the comments. And the last thing I want to mention is this video is for someone that already has a basic understanding of Qyld and the income ETFs. If you don't know how Qyld works with its covered calls, then I suggest you quickly look up income ETFs, Qyld, anything like that on YouTube. There's a ton of great videos that explain how it works. Now, with that out of the way, let's get right into it. Now, since this video is called the infinite money glitch, we need an explanation. What is the infinite money glitch? Well, using margin, you're essentially borrowing someone else's money and you're using that to increase your own portfolio, your position in an equity, or just your overall net worth. For the case of Qyld in this video, we're gonna borrow margin to buy a lot of shares of Qyld, and then using monthly dividends, we're gonna pay off our margin. And we're gonna include the cost of borrowing that money along with the taxes on the dividends that we're receiving. So what is margin? Well, margin is basically a loan against your own collateral that is charged interest daily. Right now, Robinhood offers what they call a floating margin rate. Now, what a floating margin rate means is they have a flat 2.5% rate in addition to whatever the upper bounds of the Fed funds rate is currently. So today, the Fed funds rate upper bound is 2.5%. So if you take the 2.5% and add it to the flat rate of 2.5%, you have a margin cost of 5%. That's pretty competitive. If you look at other brokerages, you're going to be paying a lot more. Now, there are some that are lower, but one, I don't have experience with them, and two, usually there's some kind of trade-off that you need to be aware of. So for my purposes, Robinhood works fine, and I'm going to continue doing that. Now, one thing to keep in mind about that floating rate is if the Fed funds rate goes up, which it has been every single month, and it probably will moving forward, or anytime there's an FOMC meeting, the margin rate is going to go up as well, the cost of borrowing that money. Now, the key points about margin investing that you need to know are going to involve being margin called. What are the risks with borrowing this money? There's always a trade-off. So I'm not going to talk about those in this video, but if you are interested, I do have a link down in the description below of a video that I did that gives an in-depth description of how margin works and the risks associated with it. Now, something else that I've linked in the description is from an absolute madman who started, I believe in 2020, maybe 2021, investing 100% in margin into Qyld. And his goal was to see what would happen, and he's been documenting it every single month, and it's pretty interesting to read. Now, the only thing you need to be aware of is he didn't just invest in margin and let it sit and pay off like we're going to talk about in here. He's used some of his own capital that he had in savings accounts to lower his margin rate so he's not being charged as much, and there's a lot of different techniques he's using that are making it more successful than if you were to just basically borrow money and see what happens. So just keep that in mind if you do decide to give that a look, but it is pretty interesting. Now, moving on from that though, Qyld, the famous ETF that typically pays around 1% per month with the major downside of a perceived capital decay over time. Though we only have about 8 years of data to go off of, we don't know if it truly will decline forever over time. Is it going to reach zero? I don't know. You guys don't know. But we do know that because of how covered call ETFs that are written on 100% of the underlying index work, we do know that we won't have as much capital appreciation over time as just investing in the underlying index like the NASDAQ 100, which is what Qyld goes off of. So why does this change? Why does it matter? Well, in 2022, we've had record inflation up to 9.1% year over year back in June of 2022. Now, today we did just come in at 8.5%, which is a little bit of a decline, which is great, but who knows what's coming. Inflation is expected to remain high for a while. So what does this mean? Well, the Federal Reserve is going to do everything in its power to smash down that inflation. So they are more than likely going to continue raising rates, which means borrowing on margin is going to cost you more and more money in the future. And if the margin goes up, that means the profits that we're making from borrowing free money are going to go down. So let's take a look at the spreadsheets and see what actually happens. Who knows? Maybe this is still a profitable strategy, or maybe it's not. Let's find out. So for the first spreadsheet we're going to look at, I'm going to explain each column and row, and then it's going to apply to each spreadsheet we look at after. And the numbers are going to look really small, but that's okay. You can pause it on your phone, you can pause it on your computer, you can zoom in and do what you need to do. So basically, all I did was starting on August 1st, 2022, and then we're just moving forward until we can pay off our margin loan. For this example, we're going to take an initial investment of $100,000 and all borrowed on margin. Now, you could change this and it would do the same thing. It would just be lower or higher depending on how much you borrowed. If we were to buy on August 1st, we would have been able to purchase just around 5,500 shares. We know that the dividend yield is around 1%. So I did a conservative 0.98%. It stays around that. There are some months where it's higher, some months where it's lower, but typically 1% is what you can see on a monthly return, annualized 12%. So margin percent, right now, for Robinhood, as I mentioned, we're looking at 5%. We have a 5% divided by 12 because we're going to pay margin monthly. Now it is charged daily, but just for the ease of the example, we're looking at it monthly. Our margin cost, what we do is we take our amount invested minus $1,000, we multiply it by our margin percent, and then we add 5. The reason for the adding 5 is because you have to pay $5 for Robinhood, and you get $1,000 of free margin. So we subtract out the $1,000, we add in the $5, and you end up with your cost. Now, our dividend is going to be the amount of shares we have times the dividend. And then our profit is going to be our dividend minus the cost. Our tax, and this is going to stay flat as well, is going to be a flat 26% on our gains. The reason I chose 26% is because the average tax in America is 22%. And then I just added a healthy 4% because some people make more money, some people live in New York. There's a lot of factors that go into it. But we're just going to assume that 26% of our profits are going immediately to Uncle Sam. And then last but not least, we have our profit after tax. So if we have a profit of $566, a dividend of $983, after taxes, it's a profit of $310. And then the way this spreadsheet works is we put it back into the margin total to subtract from our loan. So if all stays the same, the dividend yield stays around 1%, the price per share stays flat. Yes, it could go up, yes, it could go down, but it stays flat for this example. And our margin percent does not change. We're assuming that the Federal Reserve does not increase or decrease the federal funds rate. Then you could expect to borrow $100,000 of margin, invest it all into Qyld, be making profits every single month, you can see right here, to pay off your loan. And it is going to take you, it will take you around 17 years to pay off your loan. So 17 years of some risk to pay off your loan if all stays the same. But this is not an ideal scenario. So let's go a little bit deeper. So that was with assuming everything stays the same. But we already talked about inflation is high and rates are expected to go up. So as we know, the Federal Reserve is planning on increasing the federal funds rate in the near future. Assuming it goes up, that means our margin percent, our cost, is going to increase as well. So with a couple 50 basis point hikes, if we get to what is expected to be a 4% Fed funds rate, we're going to be looking at a 6.5% borrow rate, which is pretty significant when you think about the annual return on Qyld is only around 12%. Maybe even, some people even say it's closer to 10%. So for this example, if we were to scroll all the way down, because remember the goal is to pay off our margin just off of the profit after tax. Let's see, it is now going to take us until 2043. So instead of 17 years, it's going to take us an additional 4 more years to pay off if everything stays the same except the Fed funds rate increases. But let's look at the next one. But let's look at the next example. Now this one, we're going to assume that the margin cost stays the same as it is today. I know that's not likely to happen, but just for this example, let's do this. But we are going to go with a Qyld price decay of 2% per year. So in the next 10, 15, 20 years, it's not going to be $18. Perhaps it's only $14 or $15. We're going to find out. So what would happen? The other thing that is affected is that the dividend yield would actually go down because we're still going to be getting options premiums, but when the actual underlying asset costs less, the premiums are going to be less, which means that your actual dividend that's paid out per share is going to be less. If that's the case, then our profit after tax is going to be less as well. So this, now, how does this compare? When will we pay off our margin? Well, it looks like 2042. So 1 year less than if the rates just go up, but still, if Qyld drops to $15 a share, our profit at the end of the day is going to be significantly less on a monthly basis, even after we've paid off. So moving forward, we'd only be making $500-600 a month, whereas with the other one, we'd be making $730 a month or $700 a month. So, keep that in mind. Now this last spreadsheet is going to be what I consider the ideal scenario, or at least what I most believe is going to happen. Now, like I said, I'm not a financial advisor. I can't predict the future. This is just me going from the gut. I think that since we are coming out of the bear market, I think that as we see a turn in inflation towards the downside, there's going to be a likely chance that stocks start to go up. So we could see the price appreciate. Now, I don't think it's going to get back up to $25. Maybe in 20 years, it'll be around $22 a share. Who knows? That would be great. It would definitely be better than if it stays flat or goes down. Tied to that, obviously, the yield would go up if the price is going up. The next thing is I think that in the near term, we're going to see an increase in the cost to borrow. But then by around 2024, I expect the Fed to turn around and start lowering rates. And then I think we will see around a 2% Fed funds rate in the future. Is that going to happen? Who knows? But if it does, our profit is going to, at first, take a hit as the Fed funds rate goes up. But then when we start to lower, we're going to start seeing more and more profit. And if this is actually what happens, we can see the amount we borrow would actually be paid off in 2037. So only 15 years to pay off 100% free money that we borrowed. And that includes taxes, that includes the cost of borrowing the money. After that, you're seeing pretty substantial returns in profit on a monthly basis. So all in all, the Qyld infinite money glitch, borrowing money to make our own nest egg and then living off that in the future using those profits, does it work? Well, if you go off math, yes, it works. However, I still don't think it's worth the risk. If you were to just go off math, you could say, oh, well, the S&P 500 averages 9 to 10% a year over the course of time, so why not just borrow everything you can and put it in there? Because at the end of the day, there's still risk. Qyld could go down, your dividend could significantly decline. And a perfect example is what's happened over the past year. We've seen significant decline over time. We went from around $23 a share to $18 a share, even lows as low as $16 a share. And with that, the dividend went down as well. So if you borrowed high and a high amount and you're not getting that full dividend, then you're not going to be able to pay off with your profits. So definitely something to keep in mind. The other thing is I know I talked about taxes, and I just want to explain that a little bit more. Is Qyld claims that it's return of capital, but we know, and I know for a fact because I'm a Qyld investor, it does not come out as return of capital. You may see some, but more than likely, you're going to be paying ordinary income taxes because of the options premiums. Now, if this changes, awesome. I hope so. But if it doesn't, life goes on. So at the end of the day, it's up to you guys to manage your risk and determine what is the best move forward for you and your family. Now, for me, at the current rate to borrow money, I don't think investing in Qyld long-term is the answer. I do play around with day trades and stuff like that, and I definitely don't recommend that, but I feel like I can still get a better profit off of that than Qyld. That's just me. Am I right? Who knows? I want to know from you guys, if you're still watching the video, let me know in the comments, what are your thoughts on Qyld on margin? What are your thoughts on margin in general? I do my best to respond to every single comment on all of my videos. And if you haven't already, make sure you smash the like button down below, subscribe to the channel. We do weekly videos on anything related to finance or fitness. With that said, I hope to see you in next week's video. Take care.